Welcome to Barchart series of educational webinars. Today's session, profiting from the bear call spread strategy. This frequently used option strategy allows bearish traders to profit from falling prices of an underlying asset with limited risk and a defined maximum profit. Though the profits are limited, the advantages of not having large capital outlays compared to, let's say, shorting, or still better yet, a possibility of profits, even if the underlying equity doesn't move. Unlike that when we purchase a put option, which needs price movement to become profitable. This is what makes this strategy desirable to options traders. Hello, everyone. My name is John Rowland, Barchart Senior Market Strategist, and by the end of today's session, you'll have a better understanding of the bear call spread, the philosophy of the trade, the associated risks, the mechanics to construct a profitable trade using bar charts, bear call screeners. Now, to help me today with our session is our moderator and bar charts project director, Jean Baker. Hello, Jean.
Hi there, John. How are you?
How are you doing on this late summer day, dog days of summer?
Yeah, keeping busy over here. As Charles was chatting with me before we started, it's kind of a crazy day out there.
Certainly a lot of key events that are going to happen in the next 24 hours and 48 hours that are going to make the market move. So
That's right.
feels like everybody's getting positioned for that. All right, you
Well,
ready to get started, Jean?
Yeah, let's learn a little bit about this strategy that you're going to teach us today.
Okay. I just remind you that today's session is for educational purposes only, and decisions to buy, sell, or hold or trade securities, commodities, or any other investment involves risk and is best made by the advice of a qualified financial professional. Now, options trading is not for everyone, and for demonstration purposes today, all examples of trades and the data of profits and losses do not take in consideration of exchange fees, commissions, or margin costs. And under no circumstances shall we be liable for any loss or damages that you or anyone else incurs as a result of any trading or investment activity that you or anyone engages in based on the information or material you receive through barchart.com and our services. Okay, so let's start with some fundamental understanding of the principles of the bear call spread. Now, we're going to do this before we jump into a look at some more advanced details and then how we can do some trade construction. So the first is, the bear call spread here. It's a limited risk, limited reward strategy that consists of one short call option. We're going to call that leg one, and one long call option, which we're going to call leg two. Now, this strategy is best designed for traders who are bearish sentiment, and they believe that the stock or equity, or it could be an ETF, or even could be a futures contract, the price will decline or at least hold steady. In other words, stay in a very tight range. There we go. Now, since the short call option, leg one, strike is closer to current price than the long call options, leg two, strike, a credit is generated. And that's why you hear the term, this is a credit spread, a vertical credit spread. Now, the maximum profit is limited to the original credit received through fully realized if the stock price is below the lower strike at expiration. So maximum profit can only be achieved with two conditions: price below the lower strike and expiration. Now that means at some point before expiration, we might exit this trade and not receive maximum profit. Now, maximum loss or maximum risk is just the difference between the two strikes less the net credit we received. Now, break even occurs if price is above the lower strike, but not above the lower strike plus the credit that we received. So what I did here is I just put up an example, and I just picked any stock on Monday. I did this. And this is not a trade recommendation. I just wanted to show you kind of the mechanics of what it would look like in terms of our credits, our losses, our profits, and our break even. So here we're looking at Apple, and we're going to short the 175 call strike, and we're going to receive a credit of $3.95. That's down here. And we're going to buy or go long the 185 call strike, and that's going to cost us 65 cents. So the difference between those two is $3.30. So our net maximum profit or net credit would be the credit we receive minus what we put out, $3.30. So what is our maximum loss or our risk? Well, our risk is the strike differential minus the net credit. And you can see here our strikes here, 175, 185, is a difference of $10. The credit we receive, $3.30, means that the risk in this trade is $6.70. Now, what is our break even? Well, our break even in this case would be our lower strike price plus the net credit, the 175 plus the 330, or in this case, 178.30. Now, one of the things we're going to look at as we start doing trade construction is an element of how we're going to frame trades, the framing the setups of this trade. Is what we're going to try to do is we're going to try to place our break even here, our break even, at or above a level of resistance that we will locate in a lower time frame that is near current price. Now, as I did this example, a couple of days ago, that's what I'm trying to demonstrate here. Here, the break even level is at a level we might believe is a level of resistance. And setting our higher strike at a level that is above or at a level of resistance that we're going to find in a higher time frame, or in what we might consider in this case a significant swing high. Again, in this case, we can see where price had originally gapped down from, and that is where price continued to move from. So break even at lower time frame and our higher strike in a higher time frame. All right, so there's a philosophy to the trade that we need to understand. So traders who have a bearish outlook will achieve greater profits by choosing a strike call that is slightly in the money, or I would add even at current price. But there's a trade-off, and that trade-off is that there is a greater risk if the stock price does not decline, and a rise in the stock price could result in something called early assignment. Now, if a trader is slightly bearish or believes that the stock price, again, it could be another type of equity, but if the stock price is range bound, kind of just neutral, not really has any momentum one way or the other, they would be better served by choosing a short call strike at the money or slightly out of the money. Now, this is a more conservative strategy, and it will result in smaller profits. But the trade needs only that the stock price not rise above our short call strike, our lower leg one, to be profitable. Now, I'm going to offer some ideas about percentages in terms of in the money, at the money, or out of the money. But it really does come down to the individual trader and their bearish sentiment, right? Plus, we're going to look at the structure of previous price actions, and that's going to help us to frame our trade. Now, I want you to think of this as like a sliding scale, or let's say a seesaw, right? The more bearish you are, then you want to be in or at the money. Again, creating greater profits, but again, more risk. Now, if I believe that a stock is not necessarily going to go up, but maybe not also necessarily going to go down drastically, then a further away I am from current price will result in less profits, but also less risk. So another important component to this strategy is the concept of time decay, or what we call theta. Now, theta refers to the rate of decline in the value of the option as it do over passage of time. Now, it can also be referred to as time decay or sometimes premium decay. This means that an option loses value if everything else stays constant. In other words, volatility doesn't change, stock price doesn't change, right? But every day we get closer to expiration, the option loses value. So if we choose the strikes that are above current price, right, both are strikes, the value of the options is all extrinsic. In other words, time premium. If we are aggressive, right, and we are very bearish on a stock, then if we choose a lower leg, let's say is at or in the money, then the premium value would be a combination of intrinsic, how much that strike is in the money, and that extrinsic, that time premium. And that's why we need price to move in order for us to capture our maximum profit in those in and at the money scenarios. Now, my preference is somewhere around current price, maybe a little intrinsic, but I really want the majority of the premium that I'm going to collect to be time value. Now, there are some things that we can take away from this, right? Again, time is to our advantage, it's our ally. And again, the theory behind theta says that within 40 days of expiration, that's when theta really starts to pick up. And really, let's say in the last 20 days, it really starts moving exponentially. And so that's why we want to set up trades with this shorter days to expiration. In other words, probably inside of 40 days, maybe even inside, a value that's less than that. Now, there are some additional risks that we need to be aware of. So the first one is something called early assignment risk. And that generally occurs when the stock prices rises above that short call strike, our leg one, and where the intrinsic value makes it profitable for our call purchaser to exercise. In other words, to take position of the stock. Now, I want you to think about this in terms of an exit strategy, right? So we might want to exit a trade if our short strike is in the money and it has little or no time premium. That's a pretty good indication you're going to probably get assigned. Another risk is expiration risk, and this occurs when the stock price is at or slightly in the money on the day of expiration. Now, the trader might have to establish a long stock position in order to buy to cover the anticipated short position that you're going to get assigned on. So imagine this. Price is kind of bouncing around your lower strike on the day of expiration. And if you get exercised, right, the conditions of the option that you sold, you will be short the underlying. So in order to flatten your position, you might buy the stock to offset the short position. But let's say the stock doesn't move deep enough into the money to make it advantageous for our option purchaser to exercise, which means now that you're left with a newly long position and at risk that price could fall the following day. Now, why is that important? Because you won't know until the next day, the next following business day, if you were assigned, and you would be at risk to this newly established long position. Now, worse yet, you don't manage your risk and the market, you get assigned and the market gaps higher, right? And then you are really left up, you know what. Now, remember that max profit can only be achieved by those two conditions, below and at expiration. So if I'm at or near my lower strike and I'm approaching expiration, then what I probably want to do in terms of exit strategy is let's just take our winners and walk away. Let's just take that time premium that we collected and walk away, closing out a position before the end of business day of expiration. Now, if market is, a market is well below your lowest strike, then let those two options expire worthless. But I'm talking about price being at our lower leg. Now, there are other risks that we need to be aware of, and some of these risks might actually be opportunities. But corporate events, for instance, earnings, I know a lot of traders employ this type of strategy around earnings, but dividend splits, takeovers, all these kind of different odd events that could disrupt what we would call your options chain. Okay, so that's just some basics to strategy. So let's do this. I'm going to pull up I'm in options here, and I've gone to the bear call credit spread page, and here's your kind of your definition, and here's the results that we have so far today. Now, let's go over a couple of these elements, but then I want to go a little bit deeper, and I'm going to show you some techniques that you can use. So first of all, on this little cross here, what I can do is I can click on that, and this is going to bring up a chart for me, which I can look at and quickly kind of determine price characteristics. In other words, is the stock that I'm looking at, or this, this candidate, is it in an uptrend? Is it a downtrend? Is it a sideways, right? And also I can kind of like level, maybe these levels of where I want to look to set my trade up. Again, I'm just using an example here. I don't know if this is what I would do, but in Tesla, let's say, we could say, okay, 250 looks like there's a resistance, then maybe up here around 270. So maybe I'll be looking at a 250, 270 all spread. Now, the other thing we can do from the plus sign here is also go to technical analysis. And now the technical analysis page does give us some information that might be applicable to us in this scenario of this spread. For instance, stochastics or relative strength, right? These are technical analysis data points. And, maybe you want to make sure that you're not in the oversold, right? Maybe, below, let's say, 30 in the RSI or maybe 20 in the stochastics. But those are two technical analysis terms that you could use. The other one would be that I use, that I like, is look at average true range. And the average true range is just a measuring stick, how much you can anticipate price to move from high to low on any given day. If we're starting to set up trades and our break even, let's say, is inside of our average true range, we're at risk literally in the first day we're putting this trade on. Now, again, this could be a trader's preference, right? So, maybe you might use a rule to say, I want to make sure that my break even is a 1x or 1.5x outside of my average true range. Again, these are just kind of general rules in terms of what we can do in setting up trades, but I wanted to show you where you can find that information very quickly as you're doing your analysis. Now, we're going to talk about max profit, profit percentage loss, break even, but we're going to do that in a moment. I'm going to show you something else, but let's just look at a couple of things here. First of all, probability. So the general rule here is that probability is the probability of break even, but how you can determine this and use this as a rule is the closer our leg one is in the money, that's going to lower our probability. And the further away our leg one is, the higher the probability. So really what we're doing is wherever we establish our leg plus the credit we're going to get is going to create our break even. And so if break even is closer to current price, then we're going to have a lower probability. If break even is farther away from current price, then we're going to have a higher probability. Now, there is a lot of examples here. Now, I've just put the screener up here, and it's creating 1,309 examples of potential trade opportunities. Now, that's way too many for us to dig through. So let me show you a couple of simple tips here in terms of how we can narrow down these candidates from this page. But again, I'm going to also show you a little bit more in-depth details and how we can alter our filters. So the first one that we can do easily is, let's say we're familiar with a stock, right? And maybe we know that that stock or that ETF is range bound or is in a downtrend. So one of the things we can do is first is just look to see if that stock is in our filter. So I'll go to symbol, and I'm going to add the symbol. And again, I'm just going to come down here and say matches. And again, this is not a trade recommendation. I'm just using Apple as an example because I know I'm pretty confident that it will be in there. Now, again, not saying that I'm going to use Apple as a trade for a credit spread, but here you can see there's 33 examples of Apple. So another filter that we can do is we can come back into our filter, and we talked about theta. Remember, we talked about that time decay. So we could look at our days to expiration. We said that, maybe inside of 40 days would be where we start to see that theta decay. But maybe we'll say something, let's say I want to look at, inside of 30 days, right? The other thing we can do is we can look at monthly versus weekly expirations. So the theory basically behind here is, when I'm thinking about trading some of these less active options, not like Apple, which is a highly traded contract or stock, I might want to stay in monthly expirations. And the reason why is that institutions tend to trade more monthly expirations, and also you'll have greater liquidity. What does that mean? Well, that just means that our bids and asks will be a lot tighter, which means that it'll have less slippage when we get in and out of our position. And weekly ones might have less liquidity. Now, again, I'm talking about low volume markets. Now, if I'm trading a weekly option with, let's say, 3 days to go, and I'm in one of these large mega cap stocks, there's going to be liquidity, right? What I'm really doing here is just using this as a filter to keep me out of those stocks that don't have a lot of liquidity. Okay, so I could do that. So look, just on this simple filter here of making change of days and just looking at monthlies, yeah, I knocked it down a little bit, about 1,000 different candidates, right? So what are some other things that we can do? Well, we can go down here where we talk about moneyness. Remember how aggressive we want to be with our trades. Our filter here, our default filter, is at the money, 0 to -10. Now, a negative moneyness represents out of the money. In other words, our leg one will be above current price. Again, I could change this based on how aggressive I want to get towards current price. I could go a little bit in the money, and I could be maybe a little bit closer out of the money as looking for trading opportunities. Now, another aspect of this spread is I want to look for those trades where we have a high implied volatility environment. Well, what does that mean? Well, if I'm looking at a high implied volatility, what I'm really doing here is I'm saying that higher volatility options will always have that more time value premium. Again, that value that I want theta to decay. So I have a lot of different options in terms of looking at implied volatility. I can look at implied volatility over a period of time, or I can just pick implied volatility, and this is my implied volatility over, the 30 days out. And I might say something like, hey, I want an applied volatility that is going to be above 50%. So again, I just made a couple little minor adjustments here, and now look how much that knocks down our results. All right, so that's really a real easy way how we can use the spread screener to kind of look for opportunities, either a very specific symbol, change some of the parameters, our volatility, our days to expirations, our weeklies, monthlies. But what I did is I created a screener of my own. I created one and I saved it, and it's called a bear call credit screener. And so my screener right now is generating 215 different choices. Now we're going to go in here and look at the elements that are inside the screener. But I do want to say something, that these aren't cut in stone, right? I'm not saying any of these are right or wrong. I'm just using these as a jumping off point, right? And I'm going to adjust them based on the candidates that I'm getting, or maybe based on, the day of the week in terms, let's say, I'm looking for selling opportunities in these spreads on an up day in the market or on a down day in the market, right? What type of volatility or what type of aggressive or more conservative scenarios that I want to take. So the first one that I have is, I'm just going to put last price in again, and I'm going to show you why that in a moment. Although under our main view, you will get the last price. Then I'm going to add something called the short-term buy, sell, hold signal. Now, that's under our bar chart opinion. And really what this is it's looking at the technical analysis of a few different technical analysis in a shorter term. So in other words, I really kind of want to look for only those candidates that are generating a sell signal or a hold signal. In other words, kind of a neutral position. Then I have my implied volatility. Again, I want to look for a high implied volatility environment. So I just used 50 here. And then I added something called a 1 month implied volatility rank. So this is kind of a way I can do a comparison in terms of my high implied volatility. But also here is where I can make those adjustments. So what I might do in this case is I might accept a lower implied volatility for leg 1, but I want to see what that implied volatility ranks for that individual stock for that 1 month period. In other words, I could have a lower implied volatility, but I want to see a higher rank. So let's do that. So I'm going to go to a low rank. I'm going to look for implied volatility between, let's say, 20 and 50%. But I want to see those candidates that rank in, let's say, that top third, 70% or above. Now, again, my moneyness, depending on how aggressive I want to be, I could be at 0 and negative, or I could be 0 to positive, depending if I'm conservative. Net credit. So net credit is really going to be one of our trader preferences. Again, I want to kind of just make sure that I get paid for the risks that I'm going to take. Not that I wouldn't take a trade, let's say that I'm not going to receive less than $1. I'm just kind of using this as a cutoff point. And then we're going to talk about strike differential when we get the results here. In this case, I'm using 5 to 10, but I might say something, let's say, I might be looking at lower volatility stocks, so maybe my strike differential is going to be a little bit narrower. So I'm going to use 3 to 10 here. Again, I could widen this as well if I'm looking at, higher value stocks. But this is going to make sense to you in a second, this one credit to our 3 differentials. The next element that I'm going to add is net delta. Now, if you don't know where you can find net delta, I think that is under analysis. Yes, under delta. Yes, there it is. And there's net delta. Now, net delta really, again, is another trader's preference. And it's really a way where we can combine a lot of those elements that we just talked about, our differential, our credit that we're going to receive, and that theta decay. So what I really want to try to do here is I want to get enough credit based on this net delta. And what I've found is there's a kind of a sweet spot that I found in a lot of these spreads. And that sweet spot for me is somewhere between a net delta of 25 to 35. So that's why I made it to 20 and 40. But again, this could be a trader's preference. You might have a higher net delta. In other words, you're going to buy a second leg strike that is farther away, which would have a much lower delta, which would mean that your net delta will be greater. But the question then becomes, you're going to take on more risk because you're setting your second leg higher. Do you want to take on that risk based on how much extra credit you're going to receive? Again, this is just kind of a trader's preference. Net delta, net theta is really a comparative. When we get to our screen, and we'll look at that. Again, my days to expiration, 30, and let's just look at monthlies for now. And then finally, the last 2 points that I have is just open interest. Again, keeping me out of those stocks that have either no liquidity or very low liquidity. And again, I have very, very low thresholds that I'm making these stocks to jump over. And so let's see what the results are. And boom, we're down now to 26. That is a lot more manageable. Okay, so let's do this now. Let's eyeball some of these filter results and determine some profitable candidates. So again, why I use that current price. I want to see where current price is in a relationship to my strikes. Again, in this example here, we're just a little bit out of the money, or excuse me, we're really at the money, right? $99.28 versus our leg one of 100. Again, this is how I can determine how aggressive or conservative I want to be. My max profit. So again, remember, our max profit is going to be determined by how aggressive we are. But one of the things that we can do is we can relate this back to our strike differential. And what we want to try to strive to do is we want to try to capture about 1/3 of the differential. Now, that's not always possible. So if I can capture, let's say, 80% or 90% of that 1 to 3 differential, then that might be a candidate that I will look at. But what I want to do is I want to stay away from where my net profit is only maybe, let's say, 10 or 20% of my differential, right? I don't want to be chasing nickels and quarters, right? If I'm going to take risk, I want to make sure I get a good payoff for it. So again, this is more of a trader's preference, but I think this is a kind of good general rule for you to use. Now, if I'm trading a weekly option with 3 days to DTE, right, until expiration, that's your preference, right? Remember, we set our preference based on a credit that we want to receive, that $1. That might eliminate a lot of those nickels and quarter trades and only looking for a greater reward opportunities. But you might not get that 1 to 3 differential because you have very little bit of time left, and it's accelerating in terms of that theta decay. So max profit percentage is kind of really a way we can look at our max profit and our differential in that 1 to 3 ratio. So the rule kind of here is if I get above 40%, I'm getting very close to that 1 to 3 ratio. Now look in this first example here, our max profit was $3.10. Our differential is $10, right? So very close to that 1 to 3 ratio. So if I can get somewhere between, let's say, 40 and 60%, I know I'm in the right ballpark. Again, a trader's preference. I might not get that if I'm talking about a limited amount of time. But also I can look at this and say, anything above 70%, now that might be a warning to me that I'm too much in the money, right? I need too much of a profit price movement to gain that profit. And you can see that in this example here, we have a max profit percentage of 90, and you can see that our leg one is at $95, right? $4 below current price, right? So a lot of this premium that I'm going to pick up is based on this intrinsic value, this $4 that we're in the money. So that might not be a great trade for me, right? Because I really want to capture that premium decay. So that's a good way to use max profit. Max loss, again, is just the difference between our strike prices and our net credit that we receive. Break even, again, one of the rules we're going to use in our process is we're going to look at break even in terms of where is that break even value and where does it fall on my chart, and can I kind of line that up with a level of resistance that I'm going to hope that if price rises up there, it's going to retreat from that level. So this is the main view page, but remember we added a lot of other elements into our credit call spreads. Now, I'm just take a time out here before we go to this pages. I will let you know that in our slide file that's attached to this webinar when it becomes archived later today, you will have the opportunity to look at the example of this bear call screener that I created. All right, so here I'm looking at my views now, right? My views. And again, there's my signal, right? I want to make sure I'm only in shorts. Here's where I'm looking at that implied volatility comparison. Again, look at how high the ranks are, even though the implied volatility is not above, let's say, that 50%. My moneyness, remember our moneyness tells us that a plus is in the money and a negative is out of the money. And so you can see here, right, our moneyness is 4% in the money, right? That's that first leg that is below current price, where this one is a negative and it's above current price. So that's a way that you can quickly do that assessment.
Hey,
And
John,
there's where
John, I'm gonna ask you a favor, please. Why don't you expand or
Oh, I
collapse
got you.
your left menu so we can see your foot? There we go. Okay, thanks.
No problem, Gene. Thanks, Gene. And then let's look at net credit strike differential. And this is where we can do that, that 1 to 3 assessment. And again, both of these trades would fall under that category. There's our net delta. And again, this delta theta is really a tool that I use, and it's really not that critical to me. I just know that if this is a smaller number, it just means I'm getting more theta decay than a larger number, and that might be something that I want. And then those other aspects. So the one that kind of interests me today is, and this is really what I wanted to kind of bear out for you, is let's look at, I believe this is Bed Bath and Beyond. So notice that we have 3 different trades that all use the same leg one, 77.50. And here we see our strike differential, $5, $7.50, and $10, right? And notice that, again, if I did that strike differential, here's $1.40, or excuse me, $1.14 on a $5 differential. Is that at 1 to 3? No, it's not. My kind of general rule is if I'm doing a $5 differential, I want to get to like $1.50. But look at if I widen, right? If I go for a higher net delta, or I widen my strike differential, for instance, let's say we widen our strike differential to $10. Well, I'm going to pick up 30 cents more in credit, right? But I'm taking on $5 more worth of risk, right? Because my differential is now $5 wider. So is that worth that risk, right? Is that 30 cents? and maybe that is not worth that risk. But the other thing we can do is we can start to look at our break-even value. Then I'll go back to our main view. And then here's Bed Bath & Beyond, and you can see where those break-even values are: 78.60, 78.80, 79. So that could be a way how I can describe this trade, how I can frame this trade. So if I go into flip charts here, and I look at Bed Bath & Beyond, and I marked up a couple of these this morning because I didn't trust the market. From what, if anybody was in my session last week. So here's that strike, 775. And this is really kind of where, right, we had this big breakdown, big movement. So we looked at that $5 differential, right? And we said, well, it's not really there, right? It's close, but it's not there. So maybe what I'll do is I'll say, hey, that's the differential that I want, but I want a more credit. So maybe what I'm going to do here is I'm going to wait a couple days for price to retreat back towards our first leg. That would increase the value of that first leg strike price. So what I can do now is I could set this, let's say, what was this is the $5 one here. I can go back in here where it says links, and what I can do is I can start capturing a lot of these different scenarios that I'm looking for, these setups I want, and notice I can add options to a watch list. And it could be an options based on the underlying. Well, I already know the underlying. I really want to watch the options, right? I want to watch those options in terms of those differentials. And so I'm going to add that to a watch list. And that's what I did. I'm going to add the Bed Bath & Beyond. There's our expiration date, the September 15th, and there's our two strikes. I'm going to add that to my watch list. And then what I can do is I can go back and watch what that option is doing. Now I've added a few in here that I've been collecting during this week. Now notice here we can see, for in this example, the Bed Bath & Beyond is, I can see where the high and low is, right? And I can see where the high and low is of the two different options. So in generality here is that the higher strike is going to have less price movement, right? So what I might do here is set an alert, knowing, let's say I want to get 50 cents, $1.50 out of this, is maybe I'll say, okay, tell me, set an alert when our lower strike gets, let's say, above $2, because I know that our higher strike is probably going to be right around this 60, 65 cents. And that might give me a better opportunity to get a more credit. So that's how I can kind of use the watch list here. So let's go back to our bear spread. And again, I got to go back and change this. And what did I do here? Let's see, weeklies, and go back to our results. Okay. Oop, I'm missing one. Oh, I needed to get my applied volatility up. That's what I needed. Okay. Okay. So that's how we can use this filter setup. So again, going through the flip chart. So let's look at a couple of other ones now. The one that I was kind of looking at before we came on is actually it was Goldman Sachs I was kind of looking at. And the reason why I was looking at Goldman Sachs was, again, if I looked at that differential, right, here's a $10 differential where, I'm getting a lot of profit. Now, why is that? Well, let's look at this. My leg one is way in the money, right? So I'm getting way too much intrinsic, right? I need too much of a price movement to get profits. But the one that I was looking here was let's see, here's a $10 differential that is at the money, just slightly in the money. and we're getting $4 for our $10 differential. So that was kind of one that I was looking at. But let's say you're going to this screener here and you're not finding enough candidates, or maybe you have this expiration date in case the monthly, and maybe you want to change that. So what I can do is I can click on the symbol and I can go to where it says credit default down here, credit debit spreads, and here is our bear call. And now what we're going to see is we're going to only see the information on the spread based on this stock specific. Again, I'm going to just go pull up the September 15 monthly expiration. Now, what I might do now is come back into here and look at our chart to give us some kind of structure, right? Give us kind of some sense of where we want to set this trade. Now, immediately what I see here is, in terms of technical analysis, is that we do see that this downtrending market where we just filled this gap, and gaps are a great trading opportunity, but they're also act as support and resistance. So we've just come into support. So maybe I don't want to sell right close to current price. Maybe I want to sell a little bit higher. Certainly our most recent swing high is way up here around 360, but maybe we could say, hey, right up here around 330, 335 is an area where I believe that there is some greater resistance. So I could use that as my leg one, or I could use that as my leg two. So if I go back to my credit debit spreads bear call, so now I know that 335 level is something that I want to kind of take into consider. But notice that if I do that, right, there's a lot of opportunities here, a lot of different strike combinations. So what I can do here is I can come in here and let's screen on this. And now I'm just looking at Goldman Sachs. And what I'm going to do here is, remember, I got the idea for Goldman Sachs from the original screener, but now we're just going to screen Goldman Sachs. And let me go into options information. And I'm going to look at strike price. And I'm going to say, all right, leg one, I know that I want to be kind of maybe leg one somewhere around that 335 level. So I'm going to come in here, add that. And what I could do is I can do a greater than value. So if you want to use 335 as your value, then put in 334.99, then you'll get 335. If you put in 335, you're going to get all those or greater. Or I could do something, let's say a range. So let's say, let's go 330 to 340. And now I can really kind of zone in on that range of price that is going to be applicable to what I want to do in my trade. Now, let's make sure that you have, I did this, sorted this by, and I just noticed this now, this is the August 25th. So I have to come back in here and change my expiration date to the September 15th. And let's see what we got. All right, so you got about 48 different candidates, and then I can do that process, right? I can quickly do that. I know the differentials. I can see the differentials here, and I'm going to look for those ones that are getting me closer to that, that 35 to 40%, right? So here would be a $1.10 credit on a, what is that, a $5 differential. Maybe I want to wait for an up day in Goldman Sachs, maybe in the next couple of days, where I can get that, that 1 to 3, excuse me, 1 to 3 ratio. All right. Okay, Jeans, let's do this. Let's take a pause here for a second, because I do see that you pushed through a few questions, And I do know that you want to address a couple issues that I'm sure folks have been asking about as well.
Well,
Right?
yeah, I just want to let everybody know that the screener that John has been featuring today, the Bear Call Spread Screener, is part of a Barchart Premier membership. Uh, Barchart Premier is our top level membership. And if you are not a member or if you haven't tried it out, we offer a free 30-day trial. There are links all over our website that allow you to access that. Or you can email support@barchart.com. They'll be happy to set you up and point you in the right direction. Now, along with the Bear Call Spread Screener, there are all sorts of other option strategy screeners that are available to you with your Premier membership. So I urge you to check that out today.
Yeah, that's definitely, I would definitely give that trial period, because you really get a chance to really take all of these screeners out for a test ride, and you can really see how valuable they are. So I got a question here: is there a way to avoid assignment? And again, I think in terms of looking at our lower strike and where current price is, if you start seeing that the value of that option is all intrinsic and very little time premium, or that part of theta that we were just talking about, there's a high probability you're going to get assigned. So how do you avoid that? Well, you don't want to set your lower leg too deep in the money, right? Not too far in the money, because that increases that assignment probability. But the other part of that is, if I'm current price is near or at my lower leg as I'm approaching expiration, remember, we need those two conditions to get max profit. We need price to be below a lower strike and expiration. But if I've captured, let's say 80 or 85 or even 90% of the potential of that max profit, and price is right hanging out close to my lower leg, well, that'd be a good sign to exit the trade and again avoid that assessment probability. So Charles asked us a couple questions here. Charles, do I look at gamma? Again, gamma will be more applicable to, let's say, really short DTEs. So do I look at it? Sometimes. I'm really kind of just playing this probability of credit versus my differential, especially if I'm very opinionated in one way or another. And then, is rolling a profitable options to implement? So I'm guessing you're asking, can we roll a profitable position? Yeah, I think that's a great way to do this. And what Charles is kind of asking, let's assume we did a trade, we collected an X amount of premium, and now the stock price is, let's say, 5% below our lower leg. And we've collected, Ken, we're not going to get that maximum profit until expiration, but we've collected 85% of that credit. What I might do is roll that lower leg down, collect more credit, roll that upper leg down, correct more credit, and then as we're moving closer to that expiration. What I won't do, Charles, is if I put on one of these trades and now it's above my break even, I rarely roll up. In other words, I set a plan, I trade a plan, and I let the plan roll out. I don't want to add to a losing position, right? I think it's just good trading. Now, can you do that? Yeah, you can, but I'm not going to do that myself personally. Andrew, send through your question again about Bed Bath and Beyond, or BBY. I think that was the symbol we were looking at. I'm not familiar what you're saying. I guess you're saying, would you buy this stock?
So John, all that is that BBY is not Bed Bath and Beyond.
Oh, it's not? What is it?
It's Best Buy.
Oh, it's Best Buy. Okay.
Best Buy. Yeah.
Excuse me if I don't know all the symbols of the 5,000 different equities that are out there.
Yeah, that's an easy one to mistake, BBY. Yeah.
Yeah. So John asked more of a strategic question about, is it a good idea to have an equal amount of bull put and bear call credit spreads? So yeah, I think again, you might this, John, that might be more about the environment of the broader market. In other words, you might have a stock is trading in a downtrend or sideways or neutral market, but the overall market is bullish, right? There might be more traders that are buying calls, so there might be more premiums in the call, but right where in the case of a bull put, right? A bull put is more of a debit spread, right? So again, it could be based on, let's say, the volatility of the market or the general nature of the market, where are the better opportunities. But yeah, personally, I do have a good mix of both. Question about what is my favorite option strategy? I don't really have a favorite option strategy. I do tend to use a lot of covered calls. I just feel that that's a great way to create income on profitable positions. And if I get exercise on a covered call, I set my cover calls at a place where, hey, that's where I probably would have sold the stock anyways. Plus, I'm going to get that premium. So I would guess that would be one of the ones that I use. Yeah, John. So John follows up. Yeah, some days you just can't find the right combinations. And again, that could be based on the broader market, right? All right, so I want to end there for now. I do see a couple other questions. If I don't get all of your questions, I apologize. Please send your questions to support@barchart.com. We have a couple guys on the staffs are excellent options traders, and so they should be able to help you, or at least direct you into the right process to get your answers filled. Okay. So, what are some of the takeaways that we can talk about, or let's talk about? Is just remember again the sliding scale of risk to opportunity. There's that bear call spread screener that I use again at that jumping off point. So again, some of our takeaways. Remember the sliding scale of risk. The more aggressive I am, the closer to current price I want to be. If I'm a little bit less aggressive or more conservative, I want to be away from current price. Look at our net credit versus our differentials. We want to try to achieve that 1-to-3 ratio, but again, that might not always be possible. So look at it in terms of how much credit you're going to take on based on that risk that you want to take. So I might have a trade that where I only get 25% of the differential, but I want to make sure that I'm in a high volatility, high ranking stock, which might give me the greater credit. So what else? Well, as Gene mentioned, we do have this 30-day trial process for Barchart Plus and Barchart Premier. I would recommend that you guys check that out. And next week, or let me do this, Gene, because I know that you would like me to do this. It is not upcoming, John. Let's do archive. So I showed you that screener, and here's our protecting bear calls strategy. And Gene, you probably already, knowing you're efficient, you probably already have these up, don't you?
Yes, I do.
So you can find the download to get to that screener that I showed you guys. So you can use that as well. So next week, I don't think it's up yet on our calendar, but next week we're going to do an introspective of how to use our interactive charts. It's going to be more of a introductory level, but I think even though for a seasoned trader, we're going to expose you to a lot of the different aspects or tools or benefits, however you want to define it, of using interactive charts. So, I recommend that if you want to become a better skilled user of our tools, come on, check that out. Do you want to add anything else, Gene?
No, just
Before we
that
end it?
next week's session is going to be a great session to maybe find out a few things about different tools that are available in our charts that you may not have found yet. So John's going to cover a lot of material. It'll be a good one.
A lot of little secret tricks, maybe. I don't know. All right. Thanks, Gene. Great session today. Until next time, folks, be safe out there. The best of health and the good of all trading.